Because it is not the role of these 100-year-old stable legacy huge companies to innovate. Their role is to keep doing what they're doing and provide stability to the economy. And then you have new companies. And I think you run into problems in an industry where you don't have a lot of new entrants, right? And that has been the case historically in insurance. They've been very protected. They've been very complacent. Unlike other industries where there are lower barriers to entry, it's brutal competition. And that's how competition and capitalism are supposed to work. It's healthy for everybody. It makes the companies get better, and that accrues to the benefit of the consumer. And that's like kind of what makes our whole world work. I'm Sean Harper. I'm the founder of Kin, and this is the future of insurance.
This episode is brought to you by Medallia, the market leader in customer and employee experience. Their award-winning SaaS platform, Medallia Experience Cloud, makes all your other applications customer and employee aware. Medallia uses proprietary AI and machine learning to reveal predictive insights that drive powerful business actions and outcomes. Leading insurers like the Hartford and Farmers use Medallia to reduce churn, turn detractors into promoters, create in-the-moment cross-sell and upsell opportunities, and drive revenue-impacting business decisions. Learn more at medallia.com.
Sean, it's good to see you again. Thank you for joining me for the show this time, not just the book.
Thank you. Thanks for having me.
And I'm guessing you're still recovering from ITC, but maybe you're still on a high from it. Either way, you've been on quite a whirlwind the past couple of months now.
We've been hustling. Yeah. So I flew back on the red eye Wednesday night, and Vegas to Chicago was like a 3-hour red eye, so you don't get a lot of sleep.
No, that's like not a real red eye. It's just really
it's not enough. It's not enough. And I had like a full day of investor meetings yesterday because we're doing this whole SPAC thing. So it's like a roadshow. It is a roadshow. So that's what I was doing yesterday.
Well, so we are going to talk about the SPAC. I do want to get into that. For those listening, we recorded this right after ITC. Obviously, it's coming out a little bit later, but inquiring minds want to know: did you get to see Ludacris, or did you have to leave before that to catch your flight?
I was there at the time of Ludacris, but I just ended up hanging out with some people in some other bar, and I never made it down to the beach.
Cool. Equally valuable. All right, enough about that. So for people who don't know about Kin, give us kind of the high level and your story. We go into so much more depth of kind of the creation and the journey, because you are one of the companies that I featured in my second book. But yeah, give us kind of the high level, and there's a lot we could talk about.
Yeah, totally. So Kin, we do homeowners insurance, and we do it a bit differently than homeowners insurance. Is a huge industry. It's a $110 billion market in the US alone. And it's a very important product. Obviously, if you have a mortgage, you actually have to have homeowners insurance. Obviously, most people have mortgages. Yeah. Well, also like it's most people's biggest asset, right? It's like you got to have insurance for it. And so it's a big industry. And we do it a bit differently. So the first thing that we do differently is we're a direct-to-consumer business. And that's important because almost 100% of homeowners insurance currently is done through these retail agents. And the direct-to-consumer model offers us a lot of benefits that we can get into. But that's step one. We're direct-to-consumer. The second is we're really high-tech. The insurance industry has been really slow to adopt to a variety of changes in the world. But one of the changes they've been really slow to adopt to is changes in technology. And so you'll see this actually if you go and hang out at a big insurance company. There are all these like brilliant people there. And if you talk to them, they're all frustrated with one thing. And that's the technology at their company. It just doesn't do what they need it to do. So we're built from scratch on today's technology, and it gives us a lot of advantages. And then the third thing that we do is we actually have a really interesting financial structure, which is that we're not an insurance company. We actually manage for a fee an insurance company that's owned by our policyholders, which is really good for us for some reasons. But it's also more importantly, really great for the consumer because now there's a true alignment of incentives. And we're not in the situation that a normal insurance company would be in, where I'm like, should I pay this claim or should I keep the money? Like, we don't have that decision. It's like you either pay the claim or the money stays in this pool that belongs to the customers. And so I think it's a really nice way of aligning interests.
And that's a reciprocal exchange. That's the structure
that's a reciprocal exchange. Yeah, absolutely. Yeah.
How does we'll get into your background, but how does a non-insurance person even have a clue what a reciprocal exchange is. And we actually didn't talk about that. We mentioned that that's what you set up, but why? Like, how did you even stumble upon that? Were you seeking that sort of structure, like to have that alignment?
We thought it would be cool. So here's one of the coolest things about not knowing anything is you just go out and you ask everybody
Yeah.
and you ask all the questions, right? And so reciprocal exchanges are a model that's existed for hundreds of years. And some of the oldest companies are like Farmers is a reciprocal exchange. USAA is a reciprocal exchange.
Erie's a reciprocal. Yep. And some newer
Absolutely.
ones also, obviously.
Totally. And there's a few of us that are newer. But it's one that is sort of smaller, right? It's off the beaten path. It's a minority of the industry. And so when we were starting this, we wanted something that created that alignment. We had been operating as an MGA, which is an easier way to get started when you're in this business, because starting an insurance company takes like just a lot of capital and time and regulatory approval. And we wanted something where we got more control than being an MGA, and that created this line of incentives. So I just started telling people like, hey, isn't there something that I could do that would create this? And I asked enough people, and finally one of my very early angel investors, I remember, I have the text saved. I saved a screenshot of it. Whereas this was like 4 years ago, he texted me on a Saturday. He was like, have you ever heard about a reciprocal exchange before? And that was it. So I just asked enough people the question and they gave me the answer.
I love that. Like that's such a sign of kind of the fresh start that you're talking about, is like, we made a key strategic capital structuring decision through text. That's awesome. And you're not an insurance guy. You're not new to startups. You're not new to the finance space or the startup in fintech finance kind of world. But you did go about sort of understanding, size things up, where is there a great opportunity, but you did see that this issue. I love, when we go into your story, your time serving Brinks and learning about like, oh, that homeowner's security system discount, and learning about the complications and actually applying it and what it does and doesn't apply to. And then what are you left with from a discount standpoint, and also watching what's changing in climate and the cost of homeowner. I mean, like kind of all that stuff. Can you give us a little sense of how that all came together, of like, this is a problem, we got to solve this?
Yeah. So Lucas, who's my co-founder, and I both had the amazing experience early in our careers of being management consultants. And it's just a great job when you're young because you get to see a ton of different things. And so I had some really good context for insurance from working, at some of these big insurance companies as a consultant. But I didn't touch it for 15 years because I worked as a VC, and I started an e-commerce company, and I started a payments company. And then coming out of the sale of my payments business, I was just looking around for something because I really had a lot of fun doing that business. I loved the financial aspect of it, and I loved being able to really disrupt something that had been the same for so long. And I was like, what other things look kind of like payments?
Yeah.
And there are a lot of things, but there are a lot of those are in insurance. And what we realized after, because we had some time, right? Like we had sold our companies, so we had some time to look around. And what we realized was a lot of the same traits that, caused payments, caused stock trading, caused a lot of lending, credit cards to really, shift the way they did things. It really hadn't happened yet in insurance.
Yeah.
And so that got us fired up. And then, we were working on this interim gig at a home security monitoring company called Brinks. And that got us thinking about the applications of, the Internet of Things with respect to insurance, which actually hasn't panned out as much as we thought it would.
Still hasn't. Yeah.
Yeah. The gear isn't good enough as of yet is my take on it, but it will be.
Yeah.
It will be.
Same thing in auto, like that, Progressive was at the little plug-in dongles for, going back like 20 something years even. And it's really starting to take hold now, but it's still early days, and what you can do with them still early. So that for me is a yet, and I hope it improves, but certainly wasn't there when you were looking at it.
Yeah, for sure. And I would say it's still not there. Like the sensors are too expensive, and they're not good enough at reducing claims that it makes financial sense for the insurance company to fund the sensors. But electronics are getting better like every minute. So I don't think it'll be very long before the sensors are good enough to do that.
Yeah. So the thing that stood out to me in that whole story as you were telling it when I was talking to you for the book is when like, and this to me was what guided you on like, we need to get closer to the product, is like, you get this discount if you have a home security system, proving that you have it. And is it actually, are you paying for the monitoring, or did you just get it up front and then the insurer kind of dropped the ball and making sure you were getting the value of it? You know, that's one whole work stream, and there's costs to that. But then there's also like, on net, you're not saving all that much. And when you go to some of these markets where like wind activity, you know, down south, coastal properties, you'll save something, but it's irrelevant when you talk about the drivers of costs in your home policies. You're like, wait, I had the security system, why is my premium still so high? It's because that doesn't have much to do with what's actually driving your cost. I thought that was such an interesting thing, is how that was all coming together in the birth of the idea.
Yeah, totally. And the other thing is, that's not the only, it just seemed weird to us that the insurance process was so dependent on asking the customer for information, because that's not how other financial products work. It's not like you sign up for a credit card and they're like, let me think about the rate. Let me ask you a question. Do you usually pay your bills on time?
Yeah.
That would be insane, right? Because everyone would just say, yes, I'm very responsible.
Right.
Yet that's
how risky are you really? Let us know.
Exactly.
Yeah.
Yet here we are in insurance, and they're like, is your roof in good shape? Like, yeah, man, my roof is awesome.
Right.
But no one knows, right?
I've never seen it, but sure.
Yeah, exactly. Yeah. So we just thought, like, is there a way that we can alleviate? Because the customers don't like asking these questions. They're not sure. It's a lot of pain. The brokers actually end up sort of brute forcing it, right? Like if you go into an insurance agent's office, you'll often see, for personal lines, you'll often see they have Zillow up in one screen, the carrier system up in another, and they're just like copying values from Zillow, which, by the way, the values in Zillow are not always right.
Right.
We're often not right, actually.
Right. Yeah.
But they're just making guesses and stuff. And so the carrier thinks, I think in reality, they know it's not that valid, but they think they're getting this accurate, verified information about the policyholder and the policyholder's home from the agent. The reality is the agent is just like Googling it.
Right. Well, or they're thinking at a portfolio level, all those guesses kind of net out. And so it goes back to like law of large numbers is what saves us, versus a more modern kind of data centric approach is like, and you can be more exact on each risk. So you don't have to just average out between these two extremes of you're way overpriced here, super profitable, and way underpriced, and this is much worse than you realized. But on average, you're at zero, so you're fine.
Yeah, that's right. I mean, that's one of the nice things about insurance is that, you know, you do have the ability to adjust prices, right? So like if an insurance company has a bad year, or the insurance industry has a bad year, you'll see that reflected in the price level next year.
Yeah.
It's not always as fast as the insurance industry would like, but it does happen over time. Otherwise, you're just not left with a solvent insurance industry. But the more accurately we can price these things, and the more valid the data and the more data we have, the more efficient the industry gets, and the more precise the pricing gets. And it benefits everybody, actually.
Yeah. Sean, I don't know if I ended up letting you know how this played out. I think I might have sent it in an email, but when I was writing the case, you guys, actually my mother and her husband were buying a house in Florida, and the quote they got from their carrier up north was a lot. I won't go into the values of it, but tens of thousands, and they were blown away. I mean, they had no clue that that's what homeowners can cost. And obviously, like, there's coastal exposure. It's a, you know, it's a nice house. It's not like a mansion or anything, but it's a nice enough house. I was like, well, check out these guys. Just talking to the founder the other day, and you guys were about a third of the rate from the carrier that they've been with for like 20 something years longer. And my gut is not that you're just willing to take that much of a bath on every policy. To me, it was like, that's a sign of the power of when you use real analytics. And I mean, because you guys have like satellite data, you've got a number of these other data points, and the process was really easy, was the other thing she mentioned.
That's so did she become a Kin customer?
She is a Kin customer. Yes.
That's amazing.
Yeah.
Thank
and
you.
that's the part I didn't know if I'd let you know or not. And so I actually put a disclaimer in the book that I was like, you know, some people, myself or other people in my family, may or may not be a customer of some of these companies at different times.
That's true.
Yeah.
Yeah,
And
so
they were blown away by it. And the fact that they were still happy about what I think is a humongously expensive policy, just to show like, you know, the difference in the pricing down in Florida. But it was the delta. That's what made them so happy about it. But that just goes to show the power of like, well, what if you did use these other tools and other approaches?
yeah, absolutely. So there's two things going on there. The first is that because our cost structure is efficient and we don't have the retail agent we have to pay, right? So our overall pricing is less. And then because our data is so precise, we're able to more set. Now, your mom might have tried it and gotten a really, really high price from us because that does happen too, right? So it
Right.
tells
Doesn't
you
mean you're automatically cheaper.
exactly like, but in her instance, you know, we were looking at the individual traits of her home and saying, hey, this is the accurate price for it.
Yeah, it's accurate. It's not about cheaper or more expensive, which was, you know, go back to like early 2000s when Progressive was putting prices on their website and everyone was like, you know, I was at a competitor and we were like, oh, this is so stupid, or they're always going to be cheaper. And then we checked it. And it's like, no, wait, they're not cheaper on these. And we realized, no, they just care about the accuracy and they don't want the risk if someone's going to take it for less. Like, fine, go there because we know that's an insufficient price. So it's accuracy. It's not like we're always cheaper. That's not what data science is really about.
Totally. Yeah. That's cool.
Can I ask you about this distribution thing though? Because I from so many startup carriers or insurers, to say it more broadly, because some are MGA still, the notion going in, especially when the founders are outsiders, is, oh my god, you know, look at the commission on this. This is the stupidest thing we've ever seen. We got these direct to consumer solutions that we're used to from consumer goods or services or whatever. We're just going to go direct, so much cheaper, and we'll have better economics and we'll win. And then they get in, they realize like acquisition's expensive, even if you're direct, and it's really hard. And so a lot of your competitors or predecessors in the insurtech space ended up turning on agents, and they're back to, you know, supporting that same kind of channel that they said like, oh, the economics never work out. How have you been able to navigate the acquisition side, given that it's not free just because you don't have agents? So how do you do that and maintain that cost structure you were trying to achieve?
Yeah, so we look at auto insurance as a historical precedent. So if you look at Geico, their amount that they spend on marketing as a percentage of premium is like 5 or 6%. It's in that ballpark. I don't know the exact,
which
but
is a lot of money, but not percentage
it's a
wise.
lot of money. And also, by the way, Geico is everywhere, right? Like
Yeah.
they're like flying an airplane over my house with a giant banner.
Sure.
So they can spend that much money and be everywhere. But then if you look at Allstate, their marketing cost is actually like almost 20%. And that's because they also are doing a lot of advertising and they're paying the agent.
Yeah.
So we think that for homeowners insurance, it should be the same way. You know, we can actually save money by being direct, and it costs us. Now, it's not to say that it's easy, right? And I think one thing that people overlook is that the agent is doing real and valuable work.
Yes.
And some parts of that work they're very well equipped to do, like giving advice to the customer, even just like sales skills, like empathy and like human relationship.
Yeah.
People like to talk to other people, it turns out. Some parts they're not that good at. They're not, right? Like they're running a very below scale business, right? They have to do advertising themselves that they're not necessarily, you know, sophisticated at doing. And so one thing that we have at Kin that's pretty unique is we actually have a big human call center or contacts. It's not all calls, it's a lot of emails and texts and stuff like that. And we found that by investing in that human experience, we can wrap a lot of tech around it, make it pretty efficient, but also still, like, you'll see it in our reviews. Like, customers will be like, I like Kin because it was cheap. I liked it because it was really easy to do. And I loved Susan because she was so awesome to talk to. She was so helpful. She's the most helpful insurance agent I've ever talked to. It's like, that's really important. If you don't solve that, I don't think you can make direct to consumer work.
Yeah.
Because people do, it is complicated and they do want help, and you don't shop for this that often and stuff. So we've invested really heavily in that. And then the other thing that I think is really important to get is you need to be able to tie your pricing and underwriting to the marketing. And so if you look at other industries, like look at credit cards, I think is a great example. Capital One has become super expert at, you know, making sure that if they're sending you an offer, if they're showing you an ad, that you're a customer that they want, that they're going to have a good price for, they calculate the price accurately.
Yeah.
In insurance, that's really never been the case. So I think if you're spraying and praying when it comes to marketing, you waste a lot of money marketing to customers that might not be a good fit for you. So that's one thing that we've really invested a lot of data science in, is like, if we're showing you a Kin ad, odds are that we're going to be a really good option for you.
Yeah.
And if you're not a good option, really you try to avoid showing you the ad, because that's just a waste of money.
Until guys like me come and break it by sending people in.
Well, that's great too.
I didn't bet whether my mom and stuff follow were a good risk or not, but hopefully it works out.
Yeah, no, I mean, and that'll happen sometimes, right? Where like we talk to a VC and they're like, I went and tried yours and it was really expensive, or you declined to offer me coverage. It's like, well, yeah, that's kind of how the whole thing works. Like, your house is really risky. That's the accurate price. Like, if you get better coverage somewhere else, go. Like, that's fine.
Right. I appreciate that. I mean, I think people who are skeptical, and part of me is like, well, Evan Greenberg just sort of threw down the gauntlet at ITC. So there, maybe people who had been skeptical and were the skepticism was waning, he might have just amped it back up. But they're hearing you talk about like, well, you just said you get a call center. So like, you're just recreating all the cost of the agent, but so does Geico. And and you're doing it with a scale that an agent won't have. Yeah, go ahead.
So if you do it right, it can be a lot cheaper. So like for us, it costs us about $500 to bring on a new customer. About $300 of that is marketing expense. About $200 of that is the people operations expense. So that's about 30% of our first year premium.
Yeah.
And that number goes to zero in subsequent years.
Yeah.
That's compared to an agent, you're paying 15% every year.
Perpetuity. Yeah.
So it's actually, like, in our case, a lot cheaper. Now, if you can't figure out how to make it cheaper, well, okay, like then he's right? Like in that case, it's not working as well.
Right.
But I heard a little bit about his presentation, and I just we shouldn't be dismissive of the great work that's being done at insurance companies, the existing ones, but also like, it would be very foolish to not recognize the problems that these old companies have.
Yeah.
And they do have real problems. They have a huge amount of technical debt. And that makes it really, really hard for them. Like, they've missed several generations of technology.
Yeah.
And replatforming an old tech system is actually really, really hard and expensive and risky. And that's a problem that new companies like us don't have.
Yeah.
And I think it's really foolish and arrogant to ignore the issues that are real issues that need to be solved collectively.
Yeah. I think your point is it's a broad one for any industry, and whether you're looking at legacy or startup, that it's easy to swear off a startup, say, okay, well, fine, they may fail. You may be right on all those fronts, but that doesn't mean there's nothing to learn from them. It doesn't mean there's nothing they're doing right. And by the same token, you can't just laugh off. I remember ITC 2019. I've told the story a bunch of times, but like, a startup founder was bemoaning State Farm, and he's like, they're going to be gone, and these dinosaurs. And I'm just like, maybe one day, but you're not going to be the one who puts them out of business. And chances are they're not. It doesn't mean that they're as innovative as you, but like, you can't just swear them off either. You have to be willing to learn from both sides. There's something to take from everyone. And so like, we need to be open.
Like, totally 100%. And the other thing is, like, let's be cognizant of what types of companies play what role in the economy.
Yeah.
Because it is not the role of these 100-year-old stable legacy huge companies to innovate.
Yeah.
That's not their role. Their role is to keep doing what they're doing and provide stability to the economy. And then you have new companies. And I think you run into problems in an industry where you don't have a lot of new entrants, right? And that has been the case historically in insurance. They've been very protected. They've been very complacent. Unlike other industries where there are lower barriers to entry, it's brutal competition. And that's how competition and capitalism are supposed to work.
Yeah.
It's healthy for everybody. It makes the companies get better, and that accrues to the benefit of the consumer. And that's like kind of what makes our whole world work. So I understand that they're threatened because they're seeing new guys come in for the first time, but I also think they should recognize that this is really healthy for us. And we should all not blame them for not jumping on the bandwagon right away, because like, they're right to be skeptical. What they have is working. Like, Chubb is making a ton of money. Allstate is making a ton of money. Like, let's not begrudge them that. They've done well.
Yeah. And there's still room to change. I mean, it's funny. Like, you look at so many other industries, like what was going on in the auto industry before Tesla came in. It's not that there was no innovation or no change, but you'd be hard pressed to get away with an argument that things haven't accelerated dramatically, that the pressure on the, I mean, subscription services, electrification, so many different things have definitely changed in the auto industry. And you got, like, love them or hate them, you have to give Elon Musk and the team at Tesla some credit for at least lighting a bit of a fire there. You see, like when JetBlue came into the airline industry, we got TVs on like every plane now, or at least Wi-Fi. And, you know, there's all these things that, like, hate the startups, maybe they won't make it, but you're right. Like, that's where the innovation is going to come from, and for good reason. And you can't necessarily expect a stable, steady state business to do that. And maybe that's too risky or disruptive to what their existence is hinging on before those things get proven out. But that's why we need both sides, and you can't just write them off.
Totally.
Plus your family, kin, right? Like, the name means something. Shauna, I think it'd be foolish not to talk about the SPAC, and I'm curious about why Gary V, which is very exciting. But yeah, like, you know, this part of me is like, okay, why SPAC versus IPO, and what are the reasons why you choose one or the other? There's a lot going on in the SPAC world, not just in insurance, and not all of it's good. So, you know, was that part of the decision making of like, what do we gain, what do we lose? I'm curious about, as much as you can talk about it, what kinds of things went into the decision, and why is that the move for you guys right now?
Yeah. So we're trying to build this big iconic company, right? And we're on our path to building this big iconic company. That is the kind of company that is public, right? So it is an inevitability that King goes public, and the market seems to be rewarding, maybe a little bit less right now than it was 6 months ago or 9 months ago, but the market is rewarding growth companies and innovative companies. And that's really exciting. So we looked at that and we said, well, you know, that might not always be the case, right? The market ebbs and flows. Right now, the market is rewarding growth companies, and we're a growth company that has really great metrics.
Yeah.
You know, our metrics with respect to unit economics are the best of the insurtech companies that I've seen anyway. I said, okay, cool. Like, this is a good time for us. Like, let's take that next step. Let's be bold and do it. And we just fell really in love. So we're in the process of merging with this SPAC called Omnichannel, and it's run by this really, really incredible entrepreneur, Matt Higgins, who's a little bit of a celebrity because he's on Shark Tank sometimes. But you know, they have some really interesting. You know, he actually like teaches the course on direct to consumer marketing at HBS.
Okay.
And he was one of the first backers of Gary V, and Gary V is very involved in the SPAC too, of Gary V's VaynerMedia.
Yep.
And, you know, Gary's like also written the book, or the books, I guess, on consumer marketing and digital marketing. So that was a really big part of it, is so much of our business, we were talking about this earlier, is about customer acquisition. You know, they can really help us in that front.
Yeah.
And then the other side of it actually is that Matt runs this huge direct to consumer venture portfolio called RSE Ventures. And his business partner in that is Stephen Ross, the giant real estate developer, the founder of Related. And so for us, that's great because it's interesting channel. We also are really interested in Florida. It's a big state for us. It's a $14 billion TAM.
Yeah. And
they also own the Miami Dolphins and this Formula One race, and a bunch of really interesting sort of media and sports assets. So, okay, that could really help us. Yeah. So we're just looking, like, we're always doing this, right? Like, with all of our investors, we want people that are not just money, because there's a lot of money out there. And we have some really great ones, right? Like on the insurance side, we have Hudson Structure. They're like some of the smartest guys in Bermuda when it comes to reinsurance. You know, we talked about Capital One earlier. Founder of Capital One is an investor, and his firm QED Ventures. So these guys are actually like really helping us build the business, which we love.
I think for people who don't understand the strategic reasons why the people are the people that you're talking to, that you just described, maybe they see Gary Vee and they're like, oh, that's just for the buzz. But that makes a lot of sense why those are the people. and maybe that's Gary's path to getting the Jets, which I guess that's his dream. So maybe it's close. Like, okay, well, they own the Dolphins, so maybe this is mine.
Yeah. Well, actually,
has he
that's
put
how
that pressure on you.
that's how Gary and Matt met, actually, because Matt
Yeah.
was the general manager or something, business guy at the Jets, and that's how he met Gary.
All right, that's cool.
Yeah.
Gary's a lot of fun. He's a super interesting guy. But yeah, I mean, I get it that when you I mean, going back to our conversation about acquisition and getting the word out there, that Gary's really successful at that. I mean, the people you're talking about have helped prove that model, which is only helpful to what you're trying to achieve if you're able to stay direct, which if you could stay that path, that defends the economics.
100%. Yeah, that's the thing. Like, the direct model is better for so many reasons. It is hard because it's new, right?
Yep.
So if you're innovating on all of this other stuff, it, I think, might be easy to say, okay, cool, we're going to use the established channel because it's there and it's easy.
Yeah.
And a really easy roadmap for it. We think it, we didn't want to do that. We didn't want to have one foot in the past. And
yeah,
we like the direct model a
lot. I want to ask you about one last thing, and that's on the climate side. And this is the first conversation you and I had, was kind of the story behind why you're targeting the markets you're targeting. And, the idea of like your insurance premium is actually a dinner table or like dinner party conversation in Florida in the way that it never would be in many other states, although the line of where that's happening is increasing. And I want to tie that to something. I was talking to David Gritz at InsurTech NY the other day, and he was saying, for a lot, actually it was on this podcast where he said this, a lot of the newer InsurTech founders been through startups before, like yourself and Lucas. I mean, kind of using the same language you use with me is like, we'd hit some singles, doubles, that kind of thing. We're looking for a home run. He's like, they're not looking at these niche markets where, no, there's not a lot of competition. You can have a successful business, but they're going for the big stuff that has more competition, but massive markets. People could hear like, oh, they're in Florida. Yeah, it's not small. The TAM's there, but it's one state. So that isn't how you're thinking about this, partially because of that climate spread. Can you talk a little bit about the dynamics that make this actually quite a big thing that we're all going to be facing?
Yeah, absolutely. So generally speaking, it's better to go after a niche than the whole market, right? Like, it's really hard to be good at everything for everybody, especially insurance, where each market is a little bit different. Like, each state is kind of like a different country when it comes to insurance. The risks are different.
Florida, especially. There's all these Floridian carriers that don't write elsewhere, pretty much.
100%. Yeah, that's right. And so first Florida, because it's a really good business opportunity, right? The carriers there are not as well known or sophisticated as some of the national carriers are. The premiums are large, which is really good for our unit economics.
Yeah.
And customers care about it more, which is really important to me as an entrepreneur. I want to make stuff that people care about. And we're in 3 states right now. We're in Florida, Louisiana, California. Those together are a $20 billion TAM. And we've really been able to focus our efforts on those states. So next for us, we're going to try to go next year from being a $20 billion TAM to a $50 billion TAM. So that's going to mean launching a few more states. There's still going to be big states. There's still going to be coastal states. There's still going to be states like California, Louisiana, and Florida that are some of the front line. They're in the front lines of climate change.
Yeah.
And so you said something earlier about insurance never being a dinner party conversation in other parts of the country. And I think, fortunately for people in the rest of the country right now, that is true, but it will not be true forever.
Yeah.
That's just the harsh reality of it, is that the weather is getting more volatile as the planet warms.
Yeah.
And that's not isolated to Florida. I think Florida was sort of like the canary in the coal mine, I guess.
Yeah.
And the skills necessary to manage this catastrophe risk and price it and really understand which home is going to be more resilient to which type of risk is a useful skill everywhere. It will become increasingly so as this, hopefully, I mean, we have to slow down global warming, like, there's no question, but we also have to figure out how to adapt to it.
Right. And if it's slowing down, until it slows down enough, we're going to have to adapt. So there's no way around either of those two big problems.
Yep.
You did hit this actually made it really hard for me to finish off the book. Is every time I thought it was done, one of the companies in there had some big news. So you guys has news about hitting 100 million in premium faster than I think anyone else had done in this space before. And then thank God I put out the book when I did, because then it was like a couple of weeks later, I see a picture of you and Gary Vee and talking about the SPAC. And I was like, otherwise I just keep the thing open because I'd have to keep updating the cases. You guys have been on a run. You have had a lot of success. What are some of the challenges that you're facing right now? Like, as you look at other states or growth or sustainability of your business, because it's been all positive, like what are some of the things that do give you, keep you up at night a bit?
Yeah. The results have been positive, but there's so many challenges and speed bumps and issues that you have to, every week we're tackling something that's, really hard. The customer that didn't have the amazing claims experience.
Yeah.
The marketing campaign that's not working, the bug in the software, because everybody has bugs in software.
Yeah.
And so there's just a lot of those. I think for us, like we sort of proved the product market fit.
Yeah.
We built the core of a really amazing team. And now it's more like, it's just a different challenge, right? Like we used to be in this discovery mode.
Yeah.
And now we're in this like scaling mode. And I always say, like, people are like, congratulations. I'm like, yeah, man, thank you. Appreciate it. But the thing you don't realize maybe about being an entrepreneur is that every time you solve a problem, you just get like 4 more problems.
Yeah.
And so, the problems we're facing right now are those of scaling, right? The company's growing really, really fast. Post COVID, right? Like we grew from 100 people to more like 350 people between the COVID shutdown and now.
Yeah.
A lot of people in the company haven't met each other.
Yeah.
That's fine. We've been able to retain our culture, but it's hard, right? You have to put effort into it and figure out, how do you get people to like be comfortable with each other if they've never met each other in person?
Yeah.
So there's a lot of stuff. We're working on, we have reinsurance. It works really, really well. But this next year we're going to try and up our game and also do a cat bond. Different kind of reinsurance, different type of capital. So there's always something new out there, like a bunch of different new things out there.
I love when people are like, I just have to get through this and then it's all good. It's like, no, it's not how anything works.
No, it's true. It's good when you get through it. You should be like, yeah, congratulations, go take a nap and get back to it.
I do want to thank you for the honesty about the journey. So like you just touched on a number of things here. For people who expect, like, you read a case study, it's all going to be sanitized. It's going to be like, oh, it's like going to a conference and every presentation is like, look how perfect it all went. And the ROI is doubled and we got more scope in less time. And like, you were really honest about like their ups and downs. There were tough times in the history. You talk about everyone signing the Declaration of Independence when you had that go live day for the carrier. And I appreciate what you brought to that, because it's a very real story with real lessons from actual experience, and not just like, oh yeah, we did this and it was great, so here's a lesson for you, do the same thing. No, it's like there's ups and downs. That's the reality of things.
Yeah. One of the really cool things about building something new and being an entrepreneur is that it's asymmetric in a good way. Like when you figure something out, it's worth a lot more than the 10 things that you tried and it didn't work. And so, to put it another way, I would tell people like, hey, stay alive, right? Because like every day you're alive is a day that something amazing can happen, but you got to be alive to do it. And that's like, a really big part of the trick of growing a company like this is, you just have to try enough things that you find a certain number that work and you lean into those and rinse and repeat. But, there's a lot of failure along the way, and that's real. It's hard, especially, I've been doing this for a long time, so I get like a little bit numb to it, but there's a lot of failure and hard work in doing one of these things, and even on a day-to-day basis, even the really successful ones, right? Like they have so many failures added up to that success.
Yeah. I was going to ask you if you have any parting wisdom, but like you just gave a soundbite and a half. So I think that was it, but if
there you go. That's all I got.
Yeah. No, that was awesome. Sean, this has been great. Like really great insight. It's a cool story to watch. And I got a mole inside the company now with my mother's policy. So I get to watch things firsthand. But congratulations to you guys and to the whole team. It's really cool to see what can be created in the industry and what you can unlock. So, I wish you guys all the best and want to keep watching what you push the industry for.
Thanks, man. It was really fun to talk. I appreciate you, doing this with me.
Good stuff. All right, Sean, be well.
Thank you. You too.
It was great to reconnect with Sean and hear kind of where things have been at, because even though it was, I don't even know, not that many months ago that we did the interviews for the case study on Kin in the book, it's insurtech. So the world is vastly different from back then. And certainly things are very different for Ken, like the SPAC. That obviously wasn't something he could have talked about since it wasn't announced yet, but I don't even know if it was in the works yet or not. Things keep moving, and that's why it's important to keep your eyes on the space, see what's going on. I'm really excited to see what Kin does and how things play out for them. And, what can we all take from that? Whether you love them or hate them or think they're going to succeed or not, there is something to learn from everyone. Obviously, I now have a vested interest in Kin doing well. I want my mom's coverage to stay in place, and she's been very happy with it. So we will keep watching the team, and I wish them all the best, all the luck in the world. And if you want to get even more detail on Kin's journey, you should pick up The Future of Insurance from Disruption to Evolution Volume 2, where Kin is one of the case studies in the book. You can grab that at future-of-insurance.com. And a thank you again to Sean and the team for giving up some time to record this episode. It's a great conversation, great insights too. I could already feel myself being like, oh, I got to make a little clip of that because that was too good to keep buried in the episode. So there's a lot of good stuff coming out of this. Thank you everyone for listening in to another episode of the show. Make sure you're sharing this with people you know and care about in the industry that can be thinking about where do we head from here. You can send them to future-of-insurance.com. They can click on podcast and pick any episode. There's links to all the podcasting platforms, to the YouTube. You can check it out however they want to take this stuff in. So thanks again to Sean, to Kin, to all of you. Thank you to Medallia for sponsoring this episode, and take care. We'll see you next time.